How much is your net worth? And here's an even more uncomfortable question. How do you compare to others? In the United States, the average net worth for people under 35 is about $183,500. For those aged 35 to 44, it's around $503,400. And here's how it breaks down for other age groups. These averages seem incredibly high, don't they? There's a good reason for that. The averages are heavily influenced by a small number of people with extraordinary wealth, making them poor indicators for the general population. In fact, in the United States, the top 10% owns 70% of the total wealth, and the top 1% alone holds 32% of all wealth. That's why we need to look at median values. The median represents the middle point when everyone is ranked by wealth. For example, among 10 people, the median would be what the fifth person has. Let's look at median net worth by age. For Americans under 35, the median net worth is $39,000. For those 35 to 44, it's approximately $135,600. And here's what it looks like for other age groups. What's particularly striking about these numbers is the growing gap. The difference between average and median starts at $154,500 for those under 35, but expands to $1,382,200 for those 65 to 74. While younger people might be able to catch up to the average through diligent saving and work, this becomes increasingly challenging with age. Over time, the wealthy accumulate substantially more assets, causing the gap between the upper class and everyone else to grow exponentially. What drives this growing disparity? You've heard the phrase, put your money to work. This isn't just a saying. It's a fundamental principle of our modern financial system and the broader economy. It's called leveraging. People with capital can use their assets to generate more income more reliably. Here's an example. Someone with $500,000 in assets can borrow $400,000 to purchase a $900,000 building. They can lease this building, and the rental income not only covers the loan payments but generates monthly profits. Typically, real estate maintains or appreciates in value over time, so total assets grow steadily. 3 years later, they've paid off their loan and the property value has increased to $1.2 million. That's how someone starting with $500,000 can more than double their assets in just 3 years. Having substantial capital provides more investment flexibility than those without it. With readily available cash, you can capitalize on opportunities immediately and diversify your investments, minimizing risk while maximizing potential returns. Naturally, stock investments can generate additional income through dividends, and when stock prices appreciate, the returns can be substantial. For business owners, capital means opportunity for expansion. Businesses typically benefit from economies of scale. More capital enables larger operations, which generally yield proportionally higher income. Let's look at U.S. business revenue data by size. While figures vary by industry, location, and economic conditions, here are the average annual revenues. Small businesses with 1 to 4 employees average $387,000 in annual revenue, while businesses with over 100 employees average over $29,750,000. Employees receive salaries from this revenue, while business owners typically retain most of the profits. Moreover, owners of larger businesses can create systems that generate income without their direct involvement as their workforce grows. About 98% of U.S. businesses are small businesses with fewer than 100 employees, and the gap between average and median revenues widens with business size. This growing disparity isn't unique to individuals. It applies equally to businesses. The principle that money works for you applies universally to both individuals and corporations. Leverage, putting money to work. This is the power of capital. And statistically, having more capital early in life correlates strongly with higher future income potential. We understand that starting with more capital early leads to greater earnings later, but the crucial question is, how? How do you build that initial capital? Most college graduates struggle to pay off student loans before their late 20s, and those without degrees often face challenges finding high-paying positions. Yes, it's challenging. But building wealth isn't necessarily complicated. The basic principle is straightforward. Save consistently and avoid unnecessary expenses. However, that's just the formula for avoiding poverty, not building wealth. The path to wealth requires something more. It requires investment. Many people feel uncomfortable when they hear about investing. Investment often gets confused with speculation, carrying negative associations. But realistically, how can ordinary people build wealth without investing? Unless you're about to launch a hit music career right now, the options are limited. Building wealth through pure income would require extraordinary earnings, which isn't realistic for most people. Learning about investing is a much more realistic path to wealth. Building wealth without investing is substantially more challenging than building wealth through investing. To keep pace with average asset growth, you'd need an annual asset increase of 8.4% from age 35 to 65. Starting at age 35 with $151,140 to reach $1,063,700 by age 50, you'd need to save $60,837 annually. That's $5,070 monthly. This is beyond reach with typical earned income. Considering the average salary for Americans under 35 is approximately $48,000, it would be impossible even saving nearly all after-tax income. Saving alone means you're the only one working. But combining saving and investing means both you and your money are working. It's like having your money work on autopilot. We've covered why investing is essential. The economy is structured so that money works for you, and choosing not to invest means voluntarily stepping out of this wealth-building cycle. In our next video, we'll explore how to start investing and manage risks effectively. We want everyone to understand these fundamental economic principles and avoid unnecessary financial losses and missed opportunities due to lack of experience. If you want to discover more economic insights with us, please subscribe and like this video.